Can open volume imbalances help you make better trading decisions? Let's find out. First, what exactly is an open volume imbalance? A typical volume imbalance is created when one candle closes and the next candle opens at a higher price, leaving a small gap, a volume imbalance. In case you missed out on the video where I explained volume imbalances in detail, click the first link in the video description to not miss out on that. Now, for a volume imbalance to be considered open, it's all about what happens to the right of that gap. Open simply means the imbalance hasn't been rebalanced by price yet. If price moves away from it immediately without even a wick filling the gap, we call it an open volume imbalance. These open imbalances act like magnets, drawing price back to rebalance them eventually. Maybe not right away, but at some point in the future. Once price returns, the imbalance is considered rebalanced. But don't get me wrong, even after they're rebalanced, volume imbalances remain relevant for future price action and are remembered by market algorithms. Open volume imbalances can be incredibly useful when trading futures. Why futures? Because in spot market charts like the euro versus the US dollar, you won't see these imbalances. Instead, you'll need to refer to the futures price chart, like 6E for the euro, to spot them. So how can open volume imbalances help in trading? They can be used for anticipating retracements, spotting continuations in a confirmed direction, choosing better stop-loss placements, identifying targets, and even adding Confluence to trailing stop-losses for maximizing profits. Why? Because, like I said, open volume imbalances act like magnets. They help us anticipate market moves and make better trading decisions. Let me show you some examples on the charts to bring this concept to life. Let's look into our first example, anticipating a retracement using the gold futures market. First, let's analyze the market structure across all three DR sessions. Here we see a DR upside model intact, with each session respecting the previous session's lows. With a long confirmation in the RDR, the probability of seeing further upside movement for the rest of the day just increased. What's next? We wait for a retracement back into the defining range to align our setup with the DR upside model and long confirmation. Here's our focus: a single open volume imbalance sitting right at the opening price of the defining range, giving us a potential retracement level to watch. As price retraces deeper into the session, it rebalances this volume imbalance. Since we're looking for a long trade, we get 4 clear rejections from the middle of the range. Price doesn't want to close below this level. What else is there? We now have a new open volume imbalance formed with this retracement back into the range. This adds Confluence for an upside move, rebalancing it in line with the DR upside model, long confirmation, and those range mid-level rejections. Set your stop loss at the -0.7 retracement inside the range. If stopped out, you've still got probabilities for another entry. And the target? The next standard deviation level of 1, offering 4R in this setup. A great example of using open volume imbalances to anticipate both a retracement and price continuation. But trust me, it gets even more interesting from here. Our second example is about anticipating continuation into a confirmed direction. We're looking at the gold futures market, specifically the Wednesday 9th October overnight DR session. First, you might recognize this aftermarket and overnight DR session setup. They both indicate a DR downside model intact, but with an early long confirmation in place, we have to be selective with targets since the ADR levels may act as barriers given the red DR box. Let's look at open volume imbalances. There aren't any inside the defining range for a retracement, but with the long confirmation we have open magnetic whips above, supporting a potential long setup. One sits at the +1 standard deviation extension with another right above, just shy of the ADR low. These offer solid target options even outside the aftermarket DR session. Finally, there's another open whip right at the aftermarket DR session highs. Remember, with this DR model, aiming too high reduces probability, so our +1 standard deviation combined with an open whip makes for an ideal target. Price retraces into the defining range, rejects 2 previous whips and pushes back above the defining range. Notice anything? As it moves back up, price creates a new open whip, one we should definitely highlight. A few moments later, price returns to rebalance this WIB, presenting a potential entry and confirming continuation using open volume imbalances as added confluence. Covering the previous WIBs with a stop loss offers a 3R trade without even approaching the aftermarket DR session levels. As price retraces a little, it creates two more open WIBs, with the upper one providing further upside confluence. Price hits the one standard deviation level, rebalances both open WIBs, finds resistance at the aftermarket DR session lows, and continues in line with the DR downside model. See how the upper open WIB is still waiting to be rebalanced? A perfect example of using open volume imbalances as extra confluence for continuation, but respecting the overall market condition and be selective with expectations. Let's look at how open volume imbalances can help with stop loss placements, using the 19th September regular DR session on gold futures. Here we have an immediate long confirmation right after the defining range has formed. With the confirmation candle, price left an open volume imbalance, which helps us anticipate a retracement back into it. It also aligns perfectly with the IDR high and closing price of the range, creating a nice support level. Slightly below, there's another open volume imbalance that we will highlight as well. And to the upside, we have two more as an extra confluence to expect further upside. As price retraces back into the defining range, it rebalances the upper open WIB and rejects the IDR high and closing price. This is a potential first entry point for the session. Here's where open volume imbalances assist in stop loss placement. If you enter here, consider including the lower open volume imbalance in your stop loss, as it almost matches the opening price. This setup still offers 3R if targeting the plus 1.5 standard deviation level. If an open volume imbalance sits deeper in the range, let's say here, using such a wide stop wouldn't make sense. As price moves away and reaches the one standard deviation level, it creates a new open WIB, giving you a possible level to trail your stop loss before reaching the target. Let's look at how open volume imbalances can be used as potential targets. We have the same DR model constellation we've seen before, but this time it's in the opposite direction. Both sessions indicate a DR upside model, but with a short confirmation, we will focus on short trades and be selective with targets, as ADR levels may act as barriers. The red DR box supports downside moves, but there aren't any open volume imbalances within the defining range itself. To the downside, we have the aftermarket DR session levels as potential targets, along with several open magnetic WIBs that serve as both downside confluences and potential targets in line with the short confirmation. Now we wait for a retracement with clear rejections to enter. The first entry based on nice rejections from the IDR low, which is the red dashed line, results in a loss. However, with the stop out, price reaches the retirement setup area and offers plenty of time to plan and execute a new trade. Targeting the aftermarket DR session highs gives 3R, but if you aim a bit deeper, say toward this open magnetic WIB, you're looking at almost 1 extra R. Keep in mind, with a DR upside model intact, the lower you aim, the lower the probability. As the session nears its end, you decide. Secure profits now or set your stop loss to break even and go for the initial target. Price continues lower, rebalances the open magnetic WIB, retraces near the entry, then rebalances all the other open WIBs in the regular trading hours. This is a great example of using open volume imbalances as targets while staying cautious with probabilities. In the next example, we will use open volume imbalances as extra confluence to trail stop losses and maximize profits. Price confirmed longs in the aftermarket DR session, leaving an open WIB with the confirmation candle. This WIB was rebalanced and offered a potential entry along with some IDR high rejections and the next standard deviation level as the minimum target. What else supports this setup? Right here we have another open volume imbalance created by the retracement. We can expect at least a push to that level, ideally even higher. As price extends in the right direction and makes a new high but hasn't quite reached the target, you could choose to trail your stop loss to secure profits. Use open volume imbalances as guides, placing your stop 3 to 4 ticks below them. In this setup, we will cover not only both WIBs but also the plus 0.5 standard deviation level close to it. As price moves closer to the target and session end, trailing the stop aggressively is wise. This open volume imbalance offers an ideal level for that. It's not done yet. You may get the chance for a major runner. Here's a thought. Consider risking only getting 2R instead of 3R by targeting a higher open WIB from the previous day's regular DR session. It's up to each trader, but look at potential it has in this case. And if you get stopped out, you still would have gained 2R. What a beautiful example of maximizing profits with strong confluences. The trade heads towards the open WIB from the previous day's session, potentially delivering up to 6R. And lastly, an example of open WIBs not always being helpful and why that can happen. In this overnight DR session, we get a long confirmation with the candle leaving an open volume imbalance. This open WIB is useful in anticipating a retracement back into the range. But once rebalanced, price just flashes through it with no rejections, eventually confirming a false DR session as both sides of the defining range are breached on a 5-minute close. So why did this happen? Here's the reason. This DR intraday cycle began with the aftermarket DR session inside the previous day's regular DR session, known as the DR range contraction model. When the ADR took out the previous day's RDR highs, probabilities already decreased for the overnight DR session to keep moving up, as the squeeze to one side had likely happened already. Notice where price ended up. It just rebalanced another open WIB right below the IDR low from the previous day's RDR session. This example shows the importance of considering overall market structure and other confluences. If low probability conditions are signaled by the DR model, for example, you need to proceed carefully. Open volume imbalances are not the holy grail for trading success or a 100% win rate. They are powerful extra confluences that must align with the overall market conditions. There are many ways to use open volume imbalances in trading. By studying previous price action and understanding what makes them significant, you can improve your results over time. As always, they are not a guaranteed tool, but they can help you make more informed decisions if used correctly, as shown in these examples. I hope you found this video insightful, and I can't wait to see you in the next one. Have a good trading week.
We're gonna take on the world.